Hi, welcome everyone to another episode of Let's Talk Special Economic Zones. I'm your host, Ainsley Brown, and in today's episode, we're going to talk about SDG Model Zones, that's the Sustainable Development Goals and Model Zones, and the Pillar 2 of the inclusive OECD Inclusive Framework, otherwise known as the Global Corporate Minimum Income Tax. How do we now design a incentive package or incentive scheme that is both SDG model zone compliant, I suppose you'd say, and also um, OECD global corporate minimum income tax compliant. How do we balance those two things? Now, when we're talking about zones, we're talking about when you hear free zones or free trade zones, free ports, enterprise areas, enterprise zones. It's all the same thing. It's a geographic area that is a government has designated as such and has created a certain incentive package or change the laws um, to accommodate that zone or to the objective of the zone is to attract investments, whether local or foreign. Um, so that's what special economic zones. Now, UNCTAD came up with this concept of SDG model zones. They rolled it out for the first time in their 2019 global investment report. Quite an interesting read. It actually was focused on special economic zones. So that's one of those ones that attracted me. It also had it in their 2022 report as well, which focused on the amongst other things, taxes and focused amongst other things on the both pillar one and pillar two of the inclusive framework, OECD inclusive framework. But Pillar 2, or the global corporate minimum tax, which is set to be 15%, basically is saying that, is trying to prevent base erosion and profit shifting, BEPS, as they call it, and a race to the bottom, where countries keep implementing lower and lower corporate income tax to attract investments. Um, that's the stated objectives. Now, the global corporate minimum income tax, several countries have already moved or are moving to implement it, and part of how it's designed, and I'll do another episode to explain it in well, not in its entirety because it's quite complex, but certain three key concepts that every investor, every investment promotion agency, every special economic zone agency needs to understand. An investor needs to understand if you're a multinational investing globally. These three key concepts are ones that you need to know. If you don't know them, you're going to have a problem going down the line. Or at least you have to have your advisors, your tax advisors know them to advise you. But you should have a ground in them. But the global corporate minimum income tax, the 15% is set up in a way that um, it doesn't take all countries to implement it, or most countries. It will take a handful of countries, partially because most foreign direct investment comes from a handful of countries: China, United States, most of the OECD countries, France, Germany, so forth, right? These are the main countries. And once they implement it, basically, all FDI has to follow that rule. And one of the key features is that in it, why it will work basically automatically is the top up. So let's say country A has a special economic zone incentive, corporate income tax incentive of 10%. And country B has implemented the OECD rule. And the FDI is coming from country B to go to country A. What it allows country, if country A doesn't do anything, meaning it's going to keep its 10%, it's like, I'm good, I'm not moving, I don't care what you say, or, it just doesn't matter to me. I am going to stick with my 10%, provided the company is in scope. That's an important proviso. In scope means that I think it's 750 million euros. They must be earning that 750 million euros globally, right? And when you add it up all together, that's what they earn. If the company doesn't earn that, they're not in scope. So maybe country A is saying, well, I don't have anybody that meets that threshold, so I'm not changing, right? And I am not going after them. No, that sets a cap on their, the type of FDI that they want. And maybe that's okay for them. But as soon as they step over into that threshold and they attract somebody that, and it will be associated for that one company, not for everybody all of a sudden. But say they attract one company and they're still at 10, and that one company comes from country B, whose minimum corporate income tax is at 15%, right? 15%. Country B has the right to top up. So do the maths. That's 5% because 10 here, 15 here. The difference is 5%. So they can say, hey, we see that our company from our country has gone to your country and they need to pay some taxes in our country because you have not gone after that. If they went after it and moved it to 15, country B would have nothing to go after, right? Because it's already taxed, right? That's basically how it operates in a nutshell. So in terms of now SDG model zones, and there are 17 SDG, Sustainable Development Goals, United Nations Sustainable Development Goals, and they're wide ranging, right? Anything from, talking about poverty and talking about, decent work and talking about life underwater and life above land and, energy, conservation and consumption and, gender equality. There's a whole host of things in it for the 17 goals, right? And of course, some of the areas are, while they're all important for achieving or SDG model zone, there are some areas that are going to be a little bit more associated or with it. And like SDG 8, I believe is, a little bit more. SDG 12, they're a little bit more. Can't remember the exact names of them right now, but I do remember that those ones stand out. Is about consumption, sustainable consumption and production and things like that. Design and sustainable cities and industrial parks and those sorts of things. Um, uh, you know, those are more in tune with what we're talking about, but the other things are also important, ending poverty and and clean water and things like that, and securing the environment in terms of life on land and life on water, underwater, things like that, and SDG 17, which is partnerships, trying to have peace and harmony, and so forth, and cooperation to achieve the goals themselves. Now, when you look at, so how do we marry those two? Something that is SDG, I don't want to say compliant, but SDG dominant, I suppose, or SDG driven, I guess would be the better term, but is also global corporate income tax pillar 2 compliant. And there are different things I think that can be put into the incentive schemes. One, we'd have to look at the three different types of incentives. You have fiscal incentives, non-fiscal incentives, and financial. Financial is basically cash. Non-fiscal is, basically government services, amped up, more efficient, faster customs clearance, things like that, faster licenses and or waiving licenses that you may need, or fees that the government may say it needs. And then the fiscal is the typical tax breaks, which is corporate income tax. So one of the policy ways you can start to look at is, let's move away from the corporate income tax for a second and look at other um, other types of taxes. So if there are land or property taxes, maybe you lower those. Um, Maybe you start to look at, particularly, I would think you'd start to look at performance-based incentives, tying the incentives to performance. So maybe if you give a tax credit, you get that credit based on, say, how much how many employees you have above a certain level being paid. So if your if your if your sorry minimum wage is $10 US, and we're saying we want you to be we want 80% of of your employees to be paid $15, then you get the tax credit. Something like that. And I'm not saying that I'm not wedded to those numbers, but it's just as an example. Also, um, in terms of um, looking at the circularity of the zone, having um, look how do you have waste from one become an input into the production of another and incentivizing it. So if there are feedstock or well, it would be waste for them and then feedstock for another. So how do you bring that? So it's kind of an eco-industrial type of mechanism or complex or eco-industrial complex. And you incentivize that, right? You give, whether it be tax credits, you give, deductions on capital allowance deductions, which basically help to lower the the taxable income, right? So before it's even taxed, it lowers your taxable income. There of course has to be limits on that and so forth for fiscal prudence by the government. But those are things that we need to start to incentivize in the production of renewable energy. Um, so when looking at it in terms of, we have to look at it from the building of the zone and operations of the zone, and then also what the zone produces. So from a building and operational standpoint, we would have the zones incentivized to build in a green way, right? Build in a green way, ensuring that there's renewable energy provision and so forth. Um, and also it's part of what the investor has to promise the government that it will do. And then you link that to the incentives to performance. Then, in terms of what it actually does, UNCTAD even has, what they call SDG industry, so to speak, like, for example, healthcare, especially after COVID-19. This is a big area of investment, of investment attraction, of an area where people are care about. And it's also linked to tourism, for example, where people fly in and, health and wellness, and fitness, all of these different things. Um, and it's also, there's a certain manufacturing element to it because clothing, wearables, that monitor, heart rate and blood pressure, all these different types of things. You have to consider, attracting those folks to come in and manufacture in your country and send out. But also because this zone is for want of a better word, a green zone. I probably should use the SDG model zone. And the Global Alliance of Special Economic Zones, Gaza, has named 50. I'm happy to say, and I rarely do this, but I'll boast that Jamaica was amongst the 50. We're happy for that. We're happy for our sustainability framework and our sustainability initiatives. Um, and just look it up. I won't get into it here. Sustain dash a dash livity. Livity is a Rastafarian term. So I'll leave it there. But if we look at these SDG model zones, so how do we create them? How do we incentivize them to be built? Then after they're built, incentivize them to be run in a sustainable way. And then as from an operational standpoint, and then as well as the investors that you attract, the occupants that you attract to come in and operate and either whatever they're building, manufacturing that is, assembling, or the services that they offer are done in a way that supports the SDG. So healthcare services. Um, there are renewable energy. You know, there are, you may not be able to do all of these, say a solar assembly plant, but you can do the brackets or something else that supports that. Um, um, the mobility, there's different types of, vehicles, electric vehicles, scooters, all these different things, are there as well, that can be manufactured in a zone, and you incentivize, or you actually go out, you market to these folks, you go out, you target them and bring them in because you're an SDG model zone. So I think that's the best way to get it. Stay away from the corporate income tax and look at the other incentives, but primarily look at the non-fiscal incentives. What are the barriers that would impede um, a company doing what they need to do to be an SDG model zone, and then clearing that as best as you can. There's some things that, of course, you can't necessarily clear, but do that. And I think that is the best way. In another episode, I'm going to get into far greater detail and get into the actual nitty gritty, but I think this sets a good frame, and we'll come back to it. So if you like this episode, please like, share, subscribe, and leave me a comment down below if you want to see me do a particular topic. And I'll get right back to you. Bye for now.